Hey, just want to kind of update you real quick on something I've kind of noticed here and want to make sure we focus on. Jobs report came out today and it was a good jobs report, nothing super spectacular. Um, and so I want to kind of show you real quick where the market's been going, and we're testing floors. Now this is the 10-year Treasury. We all know that that's just an indicator that I look at, but um, it's not directly correlated with mortgage-backed securities, and that's where interest rates are determined, mortgage-backed securities in the bond market, not the 10-year Treasury. So anybody who tells you it's a 10-year Treasury, that's incorrect. There are times when they do move in the same direction. There are times when they don't. So that's why I watch the mortgage-backed securities all day long. But I wanted to show you a little trend here that I think we're going to see a repeat of. So let's look at the 10-year Treasury going back to early January, and we're kind of seeing a pattern here where we're about 2.31 is kind of when it hits that, then it automatically let me draw some arrows here so you can kind of see. By the way, here's a good example of using Jing, as we talked about. So I'm going to capture this image real quick. Now let me show you. So what we're seeing is when we hit that 2.31 level, then we automatically see actually some decisive, strong moves up. And what that means is rates are traveling up with that as well. Significant. This was a really big move. We're now back down to exactly where that 2.31 level is, and we've seen it 1, 2, 3 times at least. I could go back further, and it's really forming a strong floor of resistance. And so I think the odds are we're probably going to see a bounce back up. Again, that's the trend. Watching the technicals. Hopefully, if we break through, we have a good way to go down before we hit this next 2.18, which is a Fibonacci level. And so that will greatly improve rates. The reason I'm bringing this up is yesterday the Fed released their Fed meeting minutes, and they basically indicated they're going to either discontinue entirely or gradually stop buying mortgage-backed securities. And they're buying about somewhere around 8 billion a week, and that's a huge number. And so if they discontinue reinvesting back into the bond market, what they're doing basically, they have about $1 trillion on their books of mortgage and treasuries. And so what they want to try and do is probably shed the mortgage-backed securities first. So as loans refinance, pay off, otherwise are retired, the Fed has been reinvesting that money back into buying more bonds in the market to the tune of about 8 billion. If they stop buying entirely, or if they gradually decrease, it's all the same result. It's one of the biggest buyers in the market disappearing. That's going to cause softness in the market, and we're going to see rates go up as a result, and they're already talking about raising rates as well. So I wanted to kind of throw this out there to you so you can kind of understand where the market is looking like it's going to go, and we have historical reference to look at back to January to kind of show us. But when and if the Fed does start to pull out, that's going to be even worse. So just want to show this out to you, share this out there with you, and then if you have any questions, give me a call. But this is great news to be able to share with your clients to give them advice on moving forward now versus later. Obviously, Fed's looking to raise rates. I don't think they're going to do it 3 times, but they're saying 3 or 4 times this year. If that happens, obviously rates go up, and then your customer's buying power is reduced. So that means affording less home. So just want to throw this out to you. Any questions, give me a holler. Working with any buyers that need my advice or have any questions, or if you have any questions yourself, feel free to give me a call. Thanks. Talk to you very soon. Have a great day.